All right, ready to start. So welcome to today's webinar, the fifth part of our series, How to Become a Professional Trader. I'm your host today, Markus Heitkoetter. I'm the CEO of Rockwell Trading, and I see that we have a couple of people here who attended the previous session. But for those of you who are the first time here, in the first 5 minutes, what we usually do is we do a quick recap of the previous sessions, what happened, because we are doing it once a month. So I'll be here, or I'm here every first Tuesday of a month with this educational series. So let's delve right into, and this is the problem if you do have a wireless mouse. I just lost my mouse. Okay, anyhow. Here we go, perfect. So what we talked about so far, and the moderator from fxstreet.com already posted the link to the recordings. All of these webinars have been recorded, and what we did in the past is that we talked about the 6 biggest mistakes of traders and how to avoid them. We talked about some basic principles, some fundamentals of trading success. We had a session dedicated to how to develop a profitable trading system in 7 easy steps. We actually, in our last session, we developed a simple trading system, and I do believe that we use the euro versus the dollar, the currency pair euro versus the dollar, for this very, very simple trading strategy that we developed the last time using the principles that we have discussed in the second or third session here. Today we're going to talk about the 10 power principles of successful trading systems, successful trading strategies, as well as pitfalls and how to avoid them. See what today's session is all about, as you can see. In the first, and let me just briefly do a recap. So the top 6 reasons why traders lose money. Here they are on the screen. And you see, the first reason why traders lose money is the lack of a trading plan. Reason number 2 is the lack of discipline to follow the plan. The third reason is the failure to control emotions. The fourth reason is the failure to accept and limit losses. Fifth reason, a lack of commitment. And the 6th reason is overtrading. And if you've been trading for a while, then most likely you made one or the other mistake. And if you're new to trading, it's very important that you pay close attention to the mistakes that other traders made, because you want to learn from these mistakes and not repeat them, because you want to start off the right foot and immediately start making money. We then talked about developing a trading system, and these were the 7 steps that we applied. First, selecting a market. Second, selecting a time frame. We were talking about the pros and cons of the different markets, stock markets, futures markets, and forex markets. And we're talking about different time frames. So we looked at smaller time frames like 1, 3, and 5 minutes, mid-sized time frames like 60 minutes, maybe daily, and also daily and weekly charts here. We then talked about different trading approaches that are out there, and you have learned that any trading system, any trading strategy is either trend following or trend fading. According to my best knowledge, there are no hybrid trading systems. So fortunately, most of the trading approaches that are out there, whether they are indicators or concepts, like for example turtle trading or the concept of Bollinger Bands, they usually come with predefined entry rules. So this makes it easy to define our entry rules. Then we talked about our exit rules, because you know that there is a saying, a monkey can enter the market. Money is made or lost when you exit the market. So we talked rather extensively about the 3 different types of exit rules that we want to apply here. First, a stop loss. A good trader has always a stop loss in the market. Second, a profit trader. So this is the difference between a good trader and a great trader. Great traders have a profit target, so they take money off the table as long as it is there. And the third is a time stop. Basically what you learned in the last 2 sessions is always know when to exit a trade, even before you enter a trade. You might want to use some discretion when it comes to your entry points, but you want to use no discretion when it comes to your exit point. You want to know exactly when you get out of the trade. And just a very important point to remember, your stop loss, never ever give a trade more room. There's only one way to move your stop loss, and this is in the direction of the trade. So towards your entry signal. As soon as possible, you might want to move your stop loss to the break-even point so that you don't give any money back to the market that you have already seen. We then talked about evaluating your system and basically some key statistics that you want to look at. And I told you that if you do not have a charting software that helps you automating your trading strategy, your trading system there, and hence do some back testing and get a performance report. If you want to do this manually, feel free to email me, and I'll give you the email at the end of the session again. We do have a trading plan template that I presented the last time, where you just log very easily, very simple. You log your trade, and it will automatically calculate the key statistics for your performance report, like profit and loss, like winning percentage, average profit per trade, average loss per trade, and so on. Just some key numbers that you have to know as a trader. And even if you're trading live right now, make sure that you're logging your trade so that at any given time, you know exactly where you stand, because this is one of the big mistakes that traders make. They trade blind. They do not have a written trading plan. And again, we have a trading plan template here that I offered in previous sessions, and feel free to email me at the end of the session here asking for the trading plan template for the trading log. I mean, we freely distribute it here to the attendees of fxtrade.com webinars, because there's a great educational platform, and I'm glad that you're taking the time out of your busy schedule here during the lunch break in trading. So right now there's anyhow nothing to trade, to educate yourself, to learn a little bit more about the markets. So make sure that you exactly know where you stand. What is your plan? And in the plan, you'll see there are some expectations that you want to write down. What do you expect from your trading plan? And then actually, you want to keep a trading log where you have the actuals and can compare it against the plan and see if you're on track or not. So if you might have some time towards the end here, I can pull up this document again for those of you who haven't been attending the previous sessions and show you how to use the document. We'll see how it goes. Usually I'm running a little bit out of time here because there are so many exciting things to talk about when it comes to trading. Anyhow, so this is regarding evaluating your system. We then talked about how to improve a trading system, a trading strategy without curbing it. You already see while we are walking through these steps here that I'm using the terms trading plan, trading strategy, trading system. Is there a difference? No. For me, there's no difference. Having a trading plan, having a trading system, or having a trading strategy mean that you have a predefined set of rules that you have to find in order to know exactly when to enter, when to exit the market, what markets you are trading on what time frame. It means that you know what you're doing instead of just gambling, because too many traders start out without a plan. They're just gambling. They're jumping into a trade. They see the market moving and they think, oh, here's the great move. They jump in just to realize that the move is already over. So if I'm using these words here, trading plan, trading strategy, trading system, it's all the same for me. A trading strategy can be automated, doesn't have to be automated. In fact, there are some pitfalls if you're automating a trading strategy, and we'll talk about that today, because many people think that automating a trading strategy is solving all their problems. No, it's not. It's creating a whole new set of problems. So I want to make sure that you're aware of the pitfalls. Seventh step is, if you do have a solid trading strategy, it should work on multiple markets, at least at related markets. So if you have developed a trading strategy for the E-mini S&P, it should work equally well on the E-mini Russell, the E-mini Dow, and the E-mini NASDAQ. If you have created a trading strategy or trading system for the dollar versus the euro currency, it should work equally well on the dollar versus the British pound, the dollar versus Australian dollar, Japanese yen versus euro, or whatever currency pair you have. So it should work on other currency pairs. Now, a truly great trading strategy works in any market and any time frame. Okay? Doesn't matter. So these are the real solid trading strategies. And today, we're going to talk about the 10 power principles. This is why it is so important in today's session. These power principles you can apply, and if you right now have a trading strategy, or right now you do have a plan, can use these power principles to evaluate your strategy, your plan, and see if this is a solid plan, if it is likely to make money in the market if you start trading it with real money. Because thus far everything might look good. By now you know how to create a plan. And so you should have a trading plan by now. If you don't have this, again, the moderator posted the links to the recording. Watch the previous sessions. They're all just 45 minutes, very well invested in your education, and you'll know how to develop a plan. Okay, Let's get started with the 10 power principles. And later on, I show you where you can get the transcript. I mean, as said, everything is recorded here, and also where you can get the documents. So I'll show this here at the end of the session. Okay. Read power principle number 1 that you should apply to your trading strategy. You should have a very few rules, and the rules should be easy to understand. In fact, you will see on the trading plan template that many of you already downloaded, or I sent it to you, you'll see that there are only 2 lines for your long entry and 2 lines for your short entry. Guys, honestly, if you cannot write down your entry signals, your conditions for entering, your criteria for entering on 2 lines, then you're having too many and you're making it too complicated. Keep in mind, markets are moving fast. If you get a signal in a split second, you have to decide whether you want to enter the market or not. You cannot pause the market like a video. You might be able to do this in your backtesting if you do it bar by bar using a replay function, that you pause it. But when it comes to live trading, you need to be absolutely sure. And you want to make sure, if you're using indicators, that these indicators do not contradict each other, that these indicators are confirming your decision. So you want to have a very, very quick checklist. And believe me, 2 or 3 points on your checklist is enough. And say, for example, is the MACD, did the MACD cross its moving average? Is the MACD pointing up? Are the moving averages, if you're using any, are they pointing up? What do the Bollinger Bands do? Do the Bollinger Bands confirm the trade? And in the premium sessions that we do here with fx3.com, we talk about very specific trading strategies. And the next premium session is coming up this Thursday, where we talk about specific trading strategies using indicators like MACD, like moving averages, like the Bollinger Bands. What else did we use? Simple trend lines. In one of the upcoming sessions, we might talk about overbought and oversold indicators like RSI or %R. So this is what's coming up in the premium sessions here. And the moderator can give you more information how to register for these premium sessions. The next is coming up this Thursday. Again, just regarding here the power principle, also regarding your exit, especially when it comes to your exit, no discretion. Make it easy. So the easiest way, actually, how to determine your exit point is in a fixed dollar amount. Many of you have listened to me previously, and you know, if, for example, I'm trading the E-mini S&P, I'm applying a stop loss of 2 points and a profit target of 3 points. I mean, it's very easy. It's not very difficult to calculate, right? I mean, I can subtract 2 and add 3 to my entry price. That's possible. If you're using complicated formulas here, you might make a mistake, especially when the markets are moving fast. So keep this in mind. And right now, take a look at your trading strategy and see if you can eliminate any of the indicators. And some of you might know that I also offer personal coaching sessions here where we validate trading plans. So I have many traders coming to me. They send me their trading plan and say, can you please take a look at it? And the first thing that I do is usually cross off some indicators that are absolutely useless and don't help you at all. And either just leave the indicators in there that are really, that tell you something, or point you in the right direction to some indicators that can be really helpful. And you will see the best trading plans just have very few rules and they're easy to understand. Think about the floor traders, okay? Secondly, you want to trade electronic and liquid markets. Liquid markets. First of all, why do we want to trade electronic markets? Well, because we need to have the instant fill that the electronic markets are offering us. Now, as you all know, Forex markets are all electronic. You get your fill instantly within a split second. Why is it so important to receive your fill instantly? Well, because as soon as you get your fill, as soon as you are in a trade, as I said, you need to know when to exit, so you have to place your stop loss and your profit target, if you have one, right now as soon as you are in a trade. Well, unless you receive your fill, you're not sure if you are in a trade or not, so you have to wait for your fill. Well, fortunately, these days, this is not a problem. Most of the markets are now electronic. Very, very few markets are still only pit traded. You know that especially in the futures markets, we have the metals like gold, silver, and platinum. We do have these markets trading electronically. We have the energies like crude oil trading electronically. We have the grains trading electronically. So at this point, as far as I know, we still have the meat markets that are not traded electronically, and even the softs and the juice, orange juice, and cocoa cocoa. How do you pronounce this? This brown powder, you know what I mean, right? Sugar, all these are now electronic. Now, very important regarding liquid markets, make sure that the market that you're trading is liquid enough. Let me give you an example. Many traders are intrigued right now by gold. Of course, because gold is moving like crazy. You know that a couple of days ago, gold has been trading at 1,033 per ounce and is now today below 900. So we have a lot of volatility here, and volatility is exactly what we want to see as traders, because money is made when the market is moving, when it's going up or down. The only time when you want to have a quiet market that is not moving is if you're selling options. So using certain option strategies where you want to use advantage or want to take advantage of the time decay, you want to have a market that is not moving. Otherwise, markets with high volatility, as we have, for example, in the grain, in the currencies, and also in gold and energies these days, this is a trader's dream. And guys, if you do not make money in these markets these days where we have these fantastic opportunities, we need to talk, all right? So I'll give you my email later on, because I don't want to say that it is easy to make money in trading, but we are definitely having some easy times here right now. Volatility has tripled and quadrupled in most of the markets, and this is exactly what we want to see. Okay. Now, liquid markets, you want to make sure that you don't start moving the markets. And I've been talking about gold. Now, gold, you know, if you look at 5-minute charts or at 15-minute charts, you might see that the volume traded on 5 or 15-minute charts is anywhere between, I would say, maybe 40 to 100 contracts. Now, just think about this. If you become a professional trader and you want to trade 20 or 30 contracts, if you put in this lot, then you start moving the market. So make sure that you're not getting split fills. Make sure that the market is not heavily jumping on you. If a larger trader steps in, make sure that you have a nice market orderly trading, because again, in trading, it's a zero-sum game. If you are selling, somebody else needs to buy from you. Now, if there are only very few market participants and you want to sell at 100, and there are only 2 other market participants at this point in the market who say, you know what, I'm just buying at 80, and the other says, I'm buying at 82. What do you do? So this is the so-called spread, and you want to keep the spread as small as possible. So check the underlying volume of the market that you are trading. What else? Have realistic expectations. Okay, now is the time to write down some numbers. You might have tested your trading strategy. You know how to evaluate your performance report, how to read your performance report. So what are valid and realistic expectations? First of all, you need to make sure if you have a trend following or a trend fading strategy. For a trend following strategy, you typically have a larger profit target than a stop loss, and therefore, typically you will see a winning percentage of anywhere between 50 and 65%. These are typical winning percentages for a trend following strategy. Now, for a trend fading strategy, usually you have a stop loss and a profit target that's more or less the same, or you might even have a stop loss that is larger than your profit target. Therefore, you're looking for more opportunities for more winning trades here. So for a trend fading strategy, it is very typical to see percentages, winning percentages between 65 and 80%, between 65 and 80%. Anything above 80%, I would be very suspicious. I don't say that these trading strategies do not exist, but I would be very suspicious, and I would look into the strategy in detail to make sure that this is not curve fitted, A, to a particular market, or B, to a particular time frame here, just to the past. So make sure it's not curve fitted. Above 80%, I would be very suspicious. Profit factor. The profit factor is calculated, and we talked about this 2 months ago. 2 sessions ago, basically. The profit factor is calculated if you take the total amount of all wins divided by the total amount of all losses. A profit factor should be anywhere between 1.3 and 2.0. Write this down. Anywhere between 1.3 and 2.0. A profit factor above 2.0 is possible, but again, I would be very suspicious. I'm talking here right now how you can identify scam systems or fraudulent systems. If it's too good to be true, then it's probably exactly that. Too good to be true. What else do you need to know? The drawdown. The maximum drawdown is typically between 10 and 20% of the expected yearly profit. So if you're looking at a forex trading system for the euro versus the dollar, for example, and the expectancy for the year is around $10,000 on certain trades, you might experience a drawdown between $1,000 and $2,000. If you see a trading system that promises you $25,000 a year with a drawdown of only $200, stay away from this system. Most probably, this is a curve-fitted system. Again, I don't say that these systems do not exist, but in the past, from what I've seen looking at hundreds of trading plans, trading strategies, and trading systems, most of those systems who were fraudulent, who were just scams, had these fantastic numbers. So these are the three key numbers that you want to look for. Winning percentage for trend following between 50 and 65%, for trend trading between 65 and 80%, a profit factor between 1.3 and 2.0, and a maximum drawdown that is anywhere between 10 and 20% of the expected yearly returns. Number 4, maintain a healthy balance between risk and reward. Right now, take a look if you have at your profit target and your stop loss. You want to make sure that first of all, your profit target is larger than your stop loss, because if this is the case, you will even make money if you have a winning percentage of only 50%. Unfortunately, I've seen trading strategies where the profit target is $100 and the stop loss is $2,000. Is this a healthy balance between risk and reward? Absolutely not. Because yes, you can have a 95, 98% winning percentage. Great. But 2 or 3 losses in a row might wipe out your trading account. You want to have this balance. And again, well, what I like to see as a healthy balance between risk and reward, I'm very conservative in my trading, so for every dollar that I risk, I want to see $1.50 to $2.50 that I gain. Again, if you just, for every dollar that you risk, you're shooting for $7, $8, maybe $10, you're trading way too aggressively. And I personally believe that you should never ever have a stop loss that is larger than your profit target. I think that the reward should always be larger than your stop loss, because as I said, even if then you have a lousy winning percentage of only 50%, you will be successful. All right, the reason power principle number 5, have a system that produces at least 5 trades a week. Why do you want to have at least 5 trades a week? Well, very easy. I mean, as a professional trader, at the end of the month, you have to pay your bills. So you want to make sure that you have as many profitable months as possible. Now let's just assume that you have a trend following strategy that is trading on weekly chart and it's just producing 1 trade per month. I know it's an extreme, but let me just get you the idea. So if it's just producing 1 trade a month, this 1 trade might be a loser, right? It might be a losing trade. What in the next month? Well, in the next month, this 1 trade could be a loser too. So you see, now you have 2 losing months. Who's paying for your bills in the meantime? Especially when you're a day trader, you want to make sure that you have at least 5 trades, because then you would have approximately 20 trades per month. Now, even with a winning percentage of 50 or 60%, you should be ahead by the end of the month. We talked about it 2 sessions ago. Trading is a numbers game, and in order to evaluate a trading strategy, you need to have at least 40 trades. And this is another power principle that's coming up very shortly here. So we'll dig deeper into this in a little bit. So 5 trades a week is the minimum. Make sure that you're not over trading, so don't have 50 trades per day. This doesn't make sense. I personally believe anywhere between 5 and 15 trades per week is all you need, because you can use leverage in the futures, in the forex, and even in the stock market to really just take the high probability trade and then trade size. So instead of trading 50 times a 1 lot, you might actually trade, I don't know, 25 times a 2 lot. No, this is not what I mean. I mean 10 times a 5 lot. Something like this. This is what I mean when saying taking the high probability trades and only taking the best trades and then trade size. All right. What else? Your trading system should allow you to start small and grow big. Your trading system, your trading strategy should be equally successful on 1 contract as it is on 10, 20, or 30 contracts. As many contracts as the market allows you to trade. And in the Forex market, this is basically unlimited since the broker is taking the other side of the trade, guaranteeing you a fill, so you'd have no problem trading 100, 200, or 300 contracts here. Now, in other markets, as I just said, for example, gold, sometimes crude oil, the DAX, you're somewhat limited in the amount of contracts that you can trade before you start moving the market yourself. Cannot easily trade 50 contracts in gold, especially if you're trading electronic gold here, because this is basically what the maximum volume in 15 minutes. Anyhow, you know that there are many martingale systems out there. I recently read an email, never ever have a loss again. And I thought, how is that possible? Yeah, and this guy basically said, well, it's very easy. And this gambling strategy that he presented here said, you first bet one contract. And then if you lose, you bet two contracts. And if you lose, you bet four contracts. And basically, every time you lose, you double up your contracts. And if you calculate it using your trading strategy, you will see that basically if you do this and eventually have a winning trade again, you will make back all the money that you lost so far plus $1, more or less. I mean, this is basically what this strategy does. Warning, martingale systems do not work because it can happen that you have 4, 5, 6 losses in a row. Just think about it. If you would have 4 losses in a row, how many contracts would you have to trade? Let's think about it. For the first loss, you're having 1. For the second loss, you're having 2. For the third loss, you're having 4. For the fourth loss, you're having 8. For the fifth loss, you're already having 16. I don't know about your account size, but I mean, you see, you might approach your limits very fast here because then it doubles again to 32 and 64, and this is where many traders or the trading account just bust. I mean, this this strategy does not work in gambling, so why would it work in trading? So make sure that you can start with one contract and work your way up here. 7th, automate as much as possible of your trading. And as I said, I personally, I'm a big believer in using some discretion in your entry signals. But when it comes to your exit signals, no more discretion. So take advantage of the fantastic tools that we have these days. Basically, every trading platform that is out there is using or is offering you bracket orders that you can use. What does it mean to have a bracket order? It means that as soon as you're entering the market, you bracket this market with a profit target and a stop loss. And this is placed as a so-called OCO order, one cancels other. So as soon as your profit target is hit, automatically your stop loss is canceled. The other way around, of course, as soon as your stop loss is hit, automatically your profit target is canceled. This is fantastic. And I mean, these days you have even the possibility to program your trading platform. If you use something like NinjaTrader, or if you use something like Button Trader or Strategy Runner. I mean, there are so many trading platforms out there. Most of them are provided by your broker free of charge. Even in the Forex markets, the trading platforms are getting more and more powerful. Use the trading platform. Take the time to learn about your trading platform and make sure that you automate, especially your exit. Okay? The more you automate, the fewer human errors you have, but please keep in mind, you cannot eliminate the human factor from trading. Just very briefly, think about this for a moment. It's basically like the chess computers that we have these days. What happens to all the chess computers? They're basically playing Remy because they're equally good. What would happen if the whole world would automate trading? Or no, let's go one step back. What would happen if somebody really discovers a trading system that can be automated? Well, pretty soon others will discover it as well, right? I mean, either he will share the secret or other will discover it as well. This is what our history as humans has taught us. Yeah, a secret does not stay a secret for a long time. Eventually, it will be discovered. Okay, so now suddenly you have computers trading the market using basically all the same algorithm. What's happening? Prices are not moving anymore. Prices are not moving anymore because we remove the emotions from trading, and you know that. The markets are moving because of greed and fear, not supply and demand, because of greed and fear. It is the reaction of traders to report that is moving the market. Like this morning, the ISM Manufacturing Index, okay? It is the reaction of the traders, how they perceive the report as being positive or negative, that is moving the market. Never a report in itself, it's moving the market. So this is very important to know. You need the human factor in trading. If you remove the human factor from trading, eventually all trading will halt and we will all be at one price. And the next morning when the market's open, bang, we'll be at another price, which is then the most efficient price where all computers agree that this is the best buy and sell point for this particular day. Okay. 8. Have a high percentage of winning trades, especially if you are rather new to trading. Why is it important to have a high winning percentage of trades? And again, should be about 50%, and preferably if you're new to trading and you get started, might want to start with a trend fading system where you have a where you have a winning percentage between 65 and 80%. Why is that important? Well, it's good for our ego, and it's good for our discipline. See, there are successful trading systems out there that just have a winning percentage of 20 to 25%, and they make money. But think about it. Can you really do it? I mean, can you really take 10 trades, out of these 10 trades, have 8 losses in a row, and then with confidence place the 9th trade? Very few traders can do this. It's all about confidence when it comes to trading, isn't it? When you place a trade, you don't want to second guess yourself. You don't want to doubt yourself. You want to have the confidence say, yes, this is a good trade. Well, your confidence will be shaken if you're wrong most of the time. So as humans, we like to be right most of the time, and this is getting our confidence up if we are right. So same in trading. This is why I recommend, especially if you're new to trading, start off with a trend fading system where you have a winning percentage of 65 to 80%. Later on, you switch then to a trend following strategy because trend following strategies in general are more rewarding, where you have a winning percentage of 50 to 65%. But make sure that you have a high winning percentage. This will help you with your confidence, which then will help you with your discipline. And think about the second mistake that traders make that cost them a lot of money, not having the discipline to follow the plan. This is one of the reasons why. All right. Test your trading strategy on at least 200 trades. Okay? Do some back testing, do some forward testing, do some orange color testing, whatever you need to do, but at least 200 trades. The more trades you have, the better will be the results. You need at least 40 trades to at all have statistically relevant results. And the margin of error goes down the more trades you have. I do not believe that you have to test it on thousands of trades, but you want to be at around 200 trades. And number 10, and I wonder if I have, no, I don't have a charting strategy for I don't have a chart for this. Choose a valid backtesting period. What do I mean with this? If, for example, you're right now looking at electronic grains, you know that the electronic grains were introduced in August, what do we have? The second year right now, August 2006, right? So do not backtest it before August 2006 because then you look at the pit market, and the pit markets have been completely different. E-mini S&P has been introduced in September 1996. Do not go back and test it before 1996 because the E-mini S&P did not exist, and if your charting software gives you data for this period, it is probably the data from the S&P broken down into E-mini contracts. This is not the same. So make sure that you're choosing a valid backtesting period. Okay, very quickly, and then I'll answer a couple of questions that we have here. Let me switch this off. Keep in mind, a trading system, a trading strategy is not an ATM. It does not mean that now you have a ATM in your front yard that you'll automatically make money. A trading system is a predefined set of rules that you have developed, and even if you have automated it, we're talking about automatic trading here, you still need to watch it. Gosh, I've been talking to so many traders who have an automated trading strategy, and they just let it run all day long without supervision. And this is as crazy as the pilot in a plane would basically go and take a nap as long as or as soon as you put the plane on autopilot. You just don't do this because too many things can happen. I mean, we can see suddenly quick reaction in the market that are unpredictable that your trading system did not take into account. You might see that the data feed is interrupted. You might lose internet. Your computer freezes. I mean, there are so many scenarios. What could happen to your trading system? So especially if you have automated it. Still, watch the system, okay? Don't walk away. This is a job. And if needed, of course, you need also to do some fine-tuning in your trading strategy in your system. If you have automated trading system, keep in mind it supports you in your trading. It does not replace the trader. A trading system, if automated, does not replace the trader. It is just supporting you. Nothing more, nothing less. All right. So the other mistake is that people or traders are evaluating the system too early. So how often should you evaluate the trading system? As I previously, you need at least 40 trades for statistically valid conclusions. Take a look at the table here. This strategy has been backtested over 700 trades. And over 700 trades, we have the numbers that you see in the left-hand column. So we have a winning percentage of 70.2%, average profit per trade of 105, a profit factor of 1.56, and a maximum drawdown of 1,963. There's a reason why I did not write down the general profit, so how much the system made, because then the first question in these webinars here is, what is this for a trading system? Where can I buy the trading system? Okay, it's just about the principles here. Okay, so after 8 trades, you see, realized a winning percentage of 81.5%. The average profit, 190%. The profit factor, a whopping 1.98. You see it here. And the maximum drawdown, only 243. Now, some traders at this point might think, hey, look at this. I'm the king of the world. I'm better than my expectations. Okay, and then they start increasing their contract size and do all kinds of crazy things. No, you don't want to do this. You see, realized after 40 trades, the system normalized itself. Now the winning percentage after 40 trades, okay, 32 more trades, is 67.5, way closer to the expected 72. The average profit is 109 versus 105 expected. Slightly better in the profit factor because we had a good run in the first 8 trades, and the drawdown thus far has been less than expected. So this is good. Always make sure that you wait before you jump to the next trade. See, there's the saying that if a woman has a bad day, she buys new shoes. If a trader has a bad day, he buys a new trading system, or he develops a new trading system, or he changes his trading system. Don't make the mistake. Have the discipline, evaluate it against these 10 principles, and then just trade it for at least 40 trades. Okay, mistake number 3, improving the system too early. The first 5 trades are crucial. See, here's the problem. If in the first 5 trades, let's assume you have 5 losses, then you start questioning the system. I mean, you see, the problem is as soon as you start trading, you're doomed anyhow. It doesn't matter. Because if the first couple of trades with your new strategy, with your systems, do not go well and you have some losses, then you say, I knew it, this system doesn't work, the strategy doesn't work, and again, as a woman buys no new shoes, the trader buys the new system and jumps on the next system. Or, even worse, you have 5 wins in the first 5 trades. And you become overconfident. As I said previously, hey, I'm the king of the world. Look at me. I'm invincible. I can now, instead of 1 lot, trade 10 lots. Yeah, right. So you see, it's very important that you keep well, or that you are well balanced, okay? You're not doubting yourself. You're not overconfident. Think about the 6 mistakes of traders. 1 mistake is letting emotions go into your way. You need to control your emotions here. Plan your trades and trade your plan. Evaluate after 40 trades. Mistake number 4, not understanding winning percentage. And I think this is the last mistake that we have here, and then we go into the questions and answer session. If you have a winning percentage of 70%, does this mean that out of 10 trades, you will have 7 winning trades and 3 losing trades? No, absolutely not. There's absolutely no guarantee that after 3 losses, there will be a winner. Yet, there are some systems out there that actually bet on this, and they say, well, if you had a couple of losses in a row, increase your contract size. Well, this is as bad as the martingale systems, right? So let me just give you a very brief example here. You know the classical coin toss example. Well, what do you have when you do a coin toss? You have a 50% winning percentage. That tail comes up, right? Head or tail, And you know, it's very rare that a coin stands on on the edge. So either you have head or you have tail. So if you toss 4 times and you have a 50% winning percentage in this very easy system, does it mean that you'll get twice head and twice tail? Absolutely not. And if you now think about it, that you toss it, you toss a coin 9 times, and 9 times head comes up. What are the odds right now that the next time when you toss it, it will be head or tail again? It's 50%. Tail is not overdue. Yeah, this coin toss, they don't have a memory. It can still happen that you toss it 10 times and you have 10 times head. This is why when we talked about evaluating your trading performance, you want to take a look at the maximum amount of losses and maximum amount of consecutive wins. So you want to make sure that you understand this. So please, guys, whatever you have read or heard, and however logical this sounded like here, that if you toss the coin 9 times and 9 times head, that now tail is overdue. No, it is not. And therefore, please never increase the number of contracts based on this. It is not logical. And if you talk to anybody who knows anything about statistics, he will tell you that doing this is pure nonsense and basically a martingale system that set you set up for failure. Because statistically, as I said, this assumption is nonsense and dangerous, and many times a very costly misconception. Let me close with this slide here, what it takes to be a winner. And actually, this was taken from a sports coach, but you'll see that this applies to trading as well. A winner, a winning trader, a winner in general, knows what it means to be a winner. A winner must set high goals and hold up to high standards. A winner is disciplined. Gosh, I highlighted this in red because this is so true in all areas of life, especially when it comes to trading. A winner has a strong motivation, a desire to succeed in trading, in the market. A winner is not one of these hobby traders who come home in the evenings and then for dessert are trading a little bit, as I see in these late night infomercials where the guy says, well, I had my day job and yesterday evening I came home and made $20,000. No, you know this. Trading is a profession, trading is a job. It doesn't come overnight. You have to learn, you have to invest time, you have to be disciplined, and you have to show some commitment here. And I'm glad that you guys are doing it by showing up here and taking the time to invest in your education here. So these are the 4 things, what it takes to be a winner. And write this down because it couldn't be more true for trading. You might want to print this out and hang it on your wall. And always, always maintain your perspective. Trading a system, trading a strategy, trading in general means that you are playing a numbers game. You might have heard about the famous Richard Dennis, who is the original turtle trader, and he once said in the book Market Wizards, interviews of top traders that Jack Schwager wrote, it is totally counterproductive to get wrapped up in the results. You have to maintain your perspective. Being emotionally deflated because you had a losing day would mean lacking confidence in what I am doing. And I avoid that because I have always felt that it is misleading to focus on short-term results. Maintain your perspective. Don't focus on short-term results. Don't lose your perspective. Wait 40 trades before you're evaluating a trading strategy. Because too many traders jump from one strategy to the next strategy, like a dog chasing many rabbits. And you know how that story ends. Do you? Okay. So, how to make money with trading strategies, with trading systems? Keep it simple. Understand the system. Understand what an indicator does. The other day, I taught a trader. I had went with him through his trading plan, and he was using stochastics. And I said, okay, so let me just ask you, what exactly do stochastics do? And I don't care how they're calculated. I just want to hear if he understands what does stochastic mean. What does it mean if a stochastic is slow stochastics, fast stochastics, if this is high or low? Well, just very briefly for all of you, Stochastics are basically taking the current closing price and comparing it to a range of the predefined set of bars. In most cases, this is 14. So, and then the stochastics is display whether the current closing price is at the high end of the range or at the low end of the range. Did you know this? Well, if not, it's time to learn a little bit about your indicators. What is a MACD? I talked about this in the last premium session. MACD is moving average, convergence, and decline. So you need to know what an indicator is measuring. Apply the 10 power principles that you have learned today and test, test, and test. Backtest, use Monte Carlo simulations, paper trade, and start trading with small lots. All right, more information. First of all, some of you might already know this. Yes, I did it. I wrote a book. And you can find information about this on the complete guide to daytrading.com. You can go there and register for sample chapters. Everything and more what we have covered here in the past 5 or 6 sessions. This is all in the book. It's not yet available, but you can already download the pages here, some sample chapters, and you'll see what is in the book. So feel free to go to this website here. If you do have any questions, send me an email to support@rockwelltrading.com. And I need to wrap out. Moderator, do I have 3 minutes to answer questions? 3 minutes, I promise. I'll be out here in 3 minutes. Let me just make sure that with the moderator it is okay. All right, thank you so much. I really appreciate it. Okay, so Bill F. was asking previously, what is the website for the trading template? Bill, please send me an email to support@rockwelltrading.com and I'll send it to you. Okay, electric, automated trading, yes. Tercilla is asking what good software to do backtesting. Well, there are a couple of programs out there. TradeStation does a good job here. Metastock does a good job. My personal favorite is Genesis Financial Trade Navigator. Their website where you can download a free trial is genesisft.com. www.genesisft.com. And it should appear in the chat here. I hope so. Okay. Yeah, CBJ remembers the slides that I had there. Says an educator that he has been trading the minis since the late 80s. Great, there weren't any minis. What's the maximum drawdown as percentage of the whole account? Well, it depends what you want to start with. You see, if the overall drawdown of a trading strategy is $2,000, well, if you put up $10,000 in your account, that's obviously 20%. Well, most probably the strategy is using just a simple one single contract, so you could only put $3,000 or $4,000 in your trading account. Therefore, it would be 50%. So the maximum drawdown is basically usually calculated in terms of percentage of the expected yearly profits and not of the account size, because the account size is highly variable here. On the Bollinger Band, how do you figure out where to put your stop loss? I think we covered this in the last premium session. And ZBYS, I do know that you are in the last premium session. And if you attend this premium session this Thursday, I'll show this again. Don't traders wear shoes? Obviously not. Okay. All right. On the coin toss, a little explication. Do you have to make more contracts if the first 5 didn't work? No! Cananas, not at all. Not at all. And I'm sorry, I have to wrap it up here. But if you do have any questions, please send me an email. And this is the last question that comes here from Stoyan. Do you really think it's good advice for newer traders to think with a counter trend system? I think trend following system is a lot easier way to start. I agree. Trend following might be easier, but you see, it's all about confidence. And you see, many times a counter trend system here has a very high winning percentage. You can use usually quite small stop losses, and you go for small gain. So you're nibbling the market. You see, you're not making a lot of money, but you're also usually not losing a lot of money. So especially if you think about it, that most traders agree that markets are moving sideways 70 to 80% of the time. A new trader might find more opportunities here, and especially new traders are usually not that experienced and that disciplined as patient as experienced traders. So this is why, Stoyan, yes, I do believe that for new traders, this could be a good way to start. Guys, I have to wrap it up here. Thank you very much for attending here. We have to clear out the room for a premium session that is coming up right now. Administrator, what is the next session that's coming up here? So just a very brief advertising. And guys, as soon as we have the recording, we will email it to you. It usually takes, moderator, am I correct, around 2 or 3 days until we have the recording up on the website. As soon as we have the recording up on the website, we will send you an email. Feel free, in the meantime, to check the website that the moderator just posted here for any updates. I wish you all a wonderful day. It was great having you. Thank you to fxtrade.com for giving us this opportunity here, for providing the platform to invite excellent educators to talk about their trading principles and their trading concepts. I'll talk to you soon. The next session is coming up the first Tuesday of May. That's it. Thank you and bye-bye.